Good morning, good afternoon, or good evening, depending on where in the world you're tuning in from. My name is Nick Ezzo. I'm the VP of Marketing here at Equilar. On behalf of both Equilar and Glass Lewis, I'd like to welcome you to a special encore rebroadcast of the in-depth review of the Glass Lewis Pay-for-Performance model. Originally aired on November 14th, this webcast set a record for the sheer number of questions that poured in through both chat and email during and after the event. And today, we're pleased to present an edited version of the broadcast during the first part of the program. Then, we're going to be joined live by Nancy Ho and Warren Chen for an interactive Q&A online here today. So, on with the show.
Good morning, and welcome to today's webcast. So before we get started, I'm instructed by my very thoughtful team here to remind you that the slides for this webinar are available at www.equilar.com/slides. And also a recording will be available sometime later this week or next week. Okay, great. So we're going to get started here. My name is Nancy Ho, and I am a Senior Product Manager here at Equilar. And joining us today is Warren Chen.
Hello, everyone. I'm the Managing Director at Glass Lewis here. I'm responsible for our pay-for-performance analysis.
So I'm going to kick us off and review today's agenda here. I'm happy to have Warren join us, and Glass Lewis has implemented a brand new pay-for-performance analysis for the upcoming proxy season, and so for the first half of the webinar, Warren will be walking us through that analysis in a little bit more detail. And then I will be spending some time talking about Equilar's market peers and show you a sample of our peer network and some examples of a strong peer and a weak peer. And lastly, a quick glimpse of the Glass Lewis model within the Equilar service platform. Okay, so going on to the next slide here. Equilar is very, very excited to form a partnership with Glass Lewis, and we are hoping to provide corporations with enhanced analysis of compensation-related corporate governance matters. And as part of this partnership, the Glass Lewis pay-for-performance model, as well as Glass Lewis's proxy paper research, will be available to all of our clients through the Equilar platform. And in addition, Glass Lewis has integrated Equilar's market-based peers as well as Equilar's compensation data into its new version of the pay-for-performance analysis. And our goal here is really just to increase transparency around say-on-pay analysis conducted by influential proxy advisors such as Glass Lewis. And through this partnership, we're able to provide information and tools for you. Hopefully they help you with your say-on-pay analysis, your comp committee meeting preparations, and ultimately really constructive engagement with your shareholders. So now I'm going to give the floor over to Warren to speak a few words about the partnership as well.
Thank you, Nancy. So, before I go into our pay-for-performance analysis, let me say something about the partnership. The starting point for any pay-for-performance analysis is a comprehensive and high-quality data and a logical, well-developed methodology, and that's why we're very excited about this partnership. Who we both are, Equilar, being the leader in executive compensation, deliver to both investors and issuers tools that are critical to examine pay for performance and constructive engagement. Since 2004, we have been providing our institutional clients with a unique way of looking at pay for performance. And And since then, after every proxy season, we kind of sharpen our pencils, so to speak, and examine the models and making improvements. And so we're on our 7th year now in analyzing pay-for-performance, and we truly believe that while this is not the only way to look at pay-for-performance, but this is a right way and a comprehensive way in looking at pay-performance. So let's get started then and talk about the theory. So, you know, the why of the model here. So our view on executive compensation is based on the premise that management's primary duty is to maximize shareholder value and performance of the company. Not too controversial, right? And so, and everyone can agree that compensation practices should align management's interests with those of shareholders. And then, right, the natural extension of these practices is that executive compensation then should be closely tied to company and stock performance. But at the same time, we recognize that many of the factors that affect a given company's performance will also affect the rest of the industry. In our view, that, you know, executive compensation should be closely tied not to absolute or overall performance, but rather to company's track record of performance relative to its peers. And that is to say that the management should be especially rewarded for directing the company in a manner that outperforms the peers. So this relationship between relative compensation and relative performance is the basis of our pay-performance model. Next slide, please. So now we talked about why we do what we do. The next question is, how do we turn these theories, premises, what have you, into something that's tangible, simple, and yet comprehensive, you know, not losing too much granularity, and devise a methodology that allows an apples-to-apples comparison. We talked about focusing on relative compensation and performance, which means that comparing the subject company's numbers via compensation numbers or performance numbers against the same set of numbers from peer companies, right? So that brings us to discussion of peers. So how do we compose a peer group so that the analysis produce relevant results and usable results? Well, so from our perspective, right, there are two ways of going about selecting peers. And you know, the first way is the macroeconomic way, if you will, right? By that I mean, you know, look at the fundamental forces that influence compensation practices, size, location, industry, what have you, and which, you know, this is macroeconomic type of method that is something that we use in previous version of our pay-performance analysis, right? Another way is what, you know, I call it micro way or macroeconomic way, a more laser-focused way. Right? This is, you know, that's one of the ways I like to describe the Equilar market peers. Right? You know, this is really an innovative way of composing peer groups, which takes into consideration market participants' opinions and some of the factors I talked about before. And Nancy, I'm sure, will go into much more detail later on. So from Glass Lewis perspective, the benefit of using Equilar market peers in addition to the innovative nature of the methodology is that, one, it more closely aligns data used by investors and companies in their analysis of compensation practices. And two, having this group of peers, using this group of peers, it really fosters more productive engagement between investors and companies on both compensation and peer selection. So again, Nancy will go into much detail as to how the peers are selected. Here, I'll just say that we use the top 15 peers within the Equilar's market peer selection. And the chart here on this line here, I think, is basically looking at number of years for companies in the Russell 3000, and the distribution of the number of years that they disclose, and 15 looks like is the most popular way number, so to speak. So if we move on to the next slide. So now that we established who do we compare the numbers to, let's talk about what we're comparing. All right, we talked about relative compensation, relative performance. So here are the performance data points that we look at. These are 5 data points that kind of runs the balance of stock performance, operating performance. All right, we look at change in shareholder return, change in operating cash flow, growth in EPS, and return on equity and return on assets. Okay. With the exception of return numbers, the data points are a weighted average of annualized 1, 2, and 3 year data. What that means is that, so just take shareholder return, for example. We take a look at the shareholder return in 3 years time frame. We annualize that number. We take a look at shareholder return in 2 year time frame. We annualize that number. And then we have 1 year shareholder return. So we have 3 annualized numbers, and we calculated a weighted average shareholder return using these 3 annualized numbers. And we give the effectively most recent year data point the heaviest weight. The return on equity and return on assets are 1 year numbers, most recent year numbers. So we can go to the next slide. Compensation. So we have 2 compensation data points in our analysis. The total compensation for CEO and the total compensation for NEOs. And the way we get total compensation is that we take some of the numbers that disclosed in the summary comp table, salary, bonus, NEIP, all other compensation. We take those numbers and we then jump to the grants table. We take the data in the grant table, number of shares granted, type of instruments, if it's options, then we take the strike price, and we look at grant date. So with those information, we do our own valuation on the grant date fair value of equity awards. And it coincides sort of to mirror the time frame that we have for performance data points. For compensation, we also look at 3 year time period. We look at 3 year weighted average compensation data points. So if we can go to the next slide. So we talked about who we're comparing the data to, what we're comparing with, why we're doing this, and now it's how, right? How are we doing this? This is my way of kind of visually represent what happens in the model. Essentially, we take the subject company's numbers, compensation numbers, or performance numbers, and we compare those numbers against the same set of numbers from the peer company, and we rank them, right? We rank them, we still keep the compensation numbers separate from performance numbers, we rank them separately, and then the gist of it is that after all the ranking, we have a final performance score or performance ranking and final compensation score or compensation ranking. And then that's the subject company's ranking amongst the peer company. Next slide, please. Now that we have two, boil everything down into two numbers, the final conversation numbers and final performance numbers, the distance between these two numbers, what we call the pay and performance gap, kind of translate into grading. Right? Its grades are assigned based on relative positions of compensation and performance ranking. We are not doing any sort of force curve in this version of the model. It's purely by looking at the gap between pay and performance of the subject company and the peers. With that, I'll turn over to Nancy.
All right, great. Thanks, Warren. That was a lot of very interesting information, and I'm actually going to show everyone here how that translates to a product vision of that translation in the Equilar platform toward the end of the presentation. But for the time being, I'd like to spend some time talking about Equilar's market peers. And Warren has already laid a nice foundation for this, and I'm just going to jump right into it. So this method is really based directly on data supplied by companies themselves. And the starting point is really disclosed peer groups reported by companies in their SEC filings. So what Equilar does is we gather the most recently reported peer group each year for all the companies in the Russell 3000. And I think the best way to really internalize our peer network method is to think of your peer network kind of as a social network. So obviously you're in the center here, right? So you're the red dot in the middle. And your network is really consists of your peers or who you know. And in addition, it also consists of your incoming peers or who knows you. And peers of your peers, and these are who your friends know, really. And lastly, the peers of incoming peers or who knows your friends in a social network. So then what we do is we take this data and we use it to construct this interconnected network of companies. And then we evaluate the strengths of these relationships and create a list of the strongest connections. And those are the Equilar marketeers. So then a question will be, how are these connections or these relationships evaluated? And there are 4 ways that we do that. And the first way is the total number of paths between 2 companies. Or really, as you can see here, the more paths or connections between the two, the stronger the relationship. And then the second way is the distance of each path. The closer, obviously, the closer the distance, or in other words, the more direct the path, the stronger the relationship. And third, we look at peer group similarity between 2 companies. And this is really just think of it as how similar are your circle of friends or your circle of peer companies. So the more similar you and another companies have in peer companies, the stronger the relationship between the 2 of you. And lastly, we evaluate the direction. We take into consideration the direction of the peer relationship as well. So think of this as I consider you a friend, but you consider me a friend. So with a reciprocated peer relationship being the strongest. Okay, so these are the 4 factors that go into an Equilar peer network and how connection strengths are evaluated between any 2 companies. And now I'm going to show you an example of how this works. here's a sample of peer network, and it's actually a scaled-down version of Home Depot's peer network. So you'll see some consumer products and retailer tickers up here. And so you'll see that you or me sits in the middle of the network here. And highlighted here in red is an example of a really strong peer. So you see that this strong peer has many paths to the target, and they identify each other as a peer and have a similar circle of peers or friends. And you can compare that to a sample of a weak Equilar market peer in the same network. So you see that for this example of a weak peer in the Home Depot network, it's got fewer paths. It doesn't have a reciprocal relationship with Home Depot, and there's less overlap between the peers. So again, if you're just following the red arrows, you'll see the influence of a strong peer in this network and how that compared to the much less influence of a weak peer in this network. Okay, and lastly, I want to show a couple of statistics here. So on average, about 57% of a target company's market-based peers are also self-disclosed peers. And in addition, the target company typically ranks at about 50th or 48th percentile in size compared to its market-based peers. And by size, I mean revenue here. So you'll see that even with using this very organic, market choice-based method, the peer group that we come up with, the target company in general, sits in the middle in terms of size relative to its peers. So now let's switch gears a little bit and go back to the model. And what I'd like to show you is what the model looks like in Equilar's service platform. So this model, to our clients and possibly others who are not familiar, sits within our Pay-for-Performance Analytics tool and along with our ISS simulation and Equilar's realizable pay model as well. But if you go to our Pay-for-Performance Analytics tool and check out the Glass-Lewis model, there will be an indicator of your overall grade, as Warren mentioned. This has two main components to it, your pay score and your performance score. And those scores translate to the letter grade that you will receive. And when you log in, you'll see an indicator of your overall grade here. And in addition, there's a section on the compensation component. Actually, I think that's the performance component. So let me jump ahead and talk about the performance component. And so this is where the 5 factors that Warren spoke about earlier, total shareholder return, earnings per share growth, operating cash flow, and the 2 returns. That's where you can find information on these performance metrics, is in the performance section. You'll have a chance to dig into the data a little bit, and you'll see your overall percentile rank relative to your peers, and that is your performance score. And so then you'll see your compensation score in details as well. So this is where information on how much on your CEO's pay package, as well as your top 5 NEO's pay package, are shown. So one of the main differences between the Glass-Lewis model and some of the other models of pay-for-performance is that Glass-Lewis looks at the pay package of your entire top 5 So in addition to your CEO, they also look at your CFO and the other NEOs. And we are disclosing 3 years of information, so you'll be able to actually look at historical compensation data as well. And I actually have a better screenshot for this in the next slide. But again, your overall percentile rank relative to your peers is your compensation score. And then lastly, you can also download your full Glass Lewis proxy paper as soon as it's published, including all the research as well as voting recommendations for your proposals from Glass Lewis. And then let's see here. Yep, I have a more in-depth look into the CEO's total comp. All the components that goes into this calculation, including how CEO transitions will be handled with a proration modifier, actually. And then also, here's a shot of the total top 5 compensation with detailed pay components as well. And also keep in mind that since we are looking at 3 years of data, your top 5 year over year might be different, and so your most recent fiscal year, the top 5 might not be the same as your last fiscal year or the year before that. So all of this information can be found within our tool, and you'll be able to do your analysis and have a better understanding of all the different data points that goes into the Glass Lewis analysis.
Welcome back. That was the encore rebroadcast of the November 14th webcast, in-depth review of the Glass Lewis Pay-for-Performance model. If you just joined us, we've arranged to have our 2 presenters back in the studio with us for some in-depth Q&A on this fascinating topic. With me today are Nancy Ho of Equilar.
Hi guys, this is Nancy. It's nice to be here and glad you could all join us today.
And Warren Chen of Glass Lewis.
Good morning. Good afternoon, everyone.
I'm really pleased that the 2 of you have been able to join us today to provide some answers to many of the questions we've received. As I mentioned earlier, we set a record for the sheer number of questions that poured in through both chat and email during and after the event. To our listeners online, if you have a question for either of the presenters, please enter it into your questions panel. We'll try to get to as many as we can. And please note either Nancy or Warren if your question is for a specific presenter. So the first question is for Nancy. Nancy, somebody asked, are potential peer companies screened for size and industry? So for peer groups, do you also use the GICS code to establish peer groups within the same industry?
Thanks, Nick. So the short answer to that is no. The market peers are not screened for size. I think in one of the previous slides I mentioned that on an aggregate basis, the target company sits a little bit below median in the peer group generated. So I think it was 46 or 48 percentile. And this trend to the median or slightly below median is actually occurring organically within the algorithm, and we're not, manually doing anything to change that at this point. And let me just, throw a couple of examples out there as well to answer this question. I'm going to use my Staples example from earlier. So if we look at Staples and Office Depot again, so last year, I believe Office Depot cleared over $11 billion in revenue. And Staples, on the other hand, had about $25 billion. So if we were to use a, let's just use the popular 1/2 to 2 times cutoff, revenue cutoff, then that would exclude Staples from Office Depot's peer group and vice versa. And now, it's really obvious that Office Depot and Staples are competitors of each other and they should be benchmarking to each other. So if we were to follow that method, we would be excluding one from the other's peer group. So then you might say, what if we use a larger cutoff, a three times multiple then? So yeah, sure, we can do that, but I'll probably be able to find another example where two close competitors are lying just outside of that 3 times multiple. So what it really gets back to is kind of where do you draw the line? And we definitely don't presume to be the expert in drawing this line, and we really assume that you, everyone out here today, you individually are experts in your own lines of business, in your own competitive landscape, and that's why this method is leveraging your self-identified peers. And on the flip side, now, I was actually talking to an institutional investor client, and this person brought up the point of Tootsie Roll benchmarking the Kraft foods. So this was a famous example of peer groups gone wrong when Tootsie Roll decided that Kraft would somehow be an appropriate peer for their exec comp benchmarking. And so this is one of the reasons that we place heavy emphasis on reciprocal peer relations. And so I have to admit I have not looked at Kraft Foods peers recently, but I'm going to assume that Kraft didn't use Tootsie Roll as one of its peers, and similarly not many of Kraft's peers did that either. So in our model, this relationship, the Tootsie Roll Kraft relationship, will be significantly downplayed. So that's on size, and then similarly for industry, I guess GICS. First, I just want to say that GICS it's a great industry taxonomy system, and there's a reason it's one of the most heavily used system in the financial community. But what we think is that when you're sitting down with your comp committee developing your peer groups, you most likely already looked at GICS. You probably already looked at industry just like size. You took them into consideration. So for the most part, we're just going to rely on your judgment and not screen by industry a second time. And then another point on this is a lot of the big companies out there tend to benchmark to a mix of different industries. We've seen that just the really big companies, there just aren't that many others in similar industries that just also happen to be big. So an example that I can think of would be United Technologies. If you look at their peer group, I think they benchmarked to 24 different companies, and it includes companies like Lockheed Martin, Northrop Grumman, DuPont, Dow Chemicals. Those are kind of companies that are in similar industries as UTC. But it also includes companies like Johnson & Johnson, Pfizer, Procter & Gamble, some of the broad-based companies. So when I was reading their proxy, I noted that, they mentioned the factors that the comp committee consider when they're selecting these peers, size, obviously industry, also global scope of operations, diversified product portfolios, and some other characteristics. So the bottom line is, every company is unique, and we recognize that, and we respect that, and we really want to preserve that uniqueness as much as possible while addressing some of that Kraft Tootsie Roll issue.
Thanks, Nancy. That was very enlightening. I appreciate the examples that you used for Kraft, Tootsie Roll, as well as United Technologies. Next question is for Warren. Warren, how does this methodology differ from what Glass Lewis used in early 2012 for the 2011 calendar year?
Yes. So the model that was just presented was a revised version of the model, updated version of the model that we started using in July this year. prior to July, we have very similar methodology. The basic methodology was the same, meaning evaluating relative performance versus relative compensation. The difference between the two, one is that this new version of the model, we're incorporating Equilar's market-based peers, whereas the prior version of the model, looking at peers based on size, based on industry, location, but the new version is using Equilar's market-based peers. The revised version of the model is looking at 3-year weighted average compensation numbers, whereas the prior version of the model only looks at the most recent year compensation. Another difference is that the updated version of the model assigns grade based on relative positions of compensation and performance, whereas the prior version of the model actually use a forced curve grading system. So those are the 3 or 4 major differences between the models.
Thanks, Warren. That sheds a lot of light on that subject. We've got lots of questions coming in here, by the way, including some of the same ones that we had last time. So we'll try to get as many of these as we can. Let's fire off another question to Nancy this time. Nancy, what happens when a company does not disclose a peer group but only uses survey data for competitive pay analysis?
Thanks, Nick. And I'm actually seeing a couple of the questions that have come in is very similar to that. I think there's a question that asked what happens if a company doesn't disclose a peer group or doesn't have a peer group. So that's related to that, so I'll address those questions together here. So unfortunately, we can only work with what we have. So if you put in your proxy that, we benchmark to, say, all the companies in the retail cut of the Equilar Top 25 survey, for example. While we know that there are hundreds of those companies out in our survey, but we're probably not going to go and identify them individually and put that into the system. Now, however, if you disclose in your proxy that you use the Equilar Top 25 survey and that within, say, the high-tech sector of the survey you picked out and benchmark to 25 companies that you consider to be the most relevant, and you also list them out in your proxy, then we will definitely take that into consideration. That'll be inputted into our algorithm for peer group. So that's what happens when a company uses survey data for their analysis. Now, for companies that don't have a peer group, unfortunately, we just don't have anything to work with. So what will happen is we will look at others in the Russell 3000 that identify you as their peer, and we'll start there. And so we will rely much more heavily on the incoming peer connections rather than the outgoing, because there is no outgoing peer connections. You did not choose a peer group for yourself. Another point, just related point to that is while we were doing this analysis, we did notice something interesting. There is a really small percentage of companies in the Russell 3000, say about 5% or so, that don't have any connections whatsoever. And I mean, they don't disclose a peer group, and there's no one out there who consider them peers. So they're essentially cut off from the rest of the network. And we actually gave these companies a nickname. We call them hermits. So if you are one of the hermits company, one of the hermits, then unfortunately we just don't have enough information for you, and we don't create a market peer group for you.
Great, thanks so much. I learned a new term here today, hermit companies. The next question, and I'll give both of you guys a chance to take a stab at this one. We'll go with Warren first. Will Glass Lewis also look at realizable compensation in addition to grant date target? And secondly, why not use 3-year realizable pay rather than a 3-year grant date pay, which is a more of a proxy for quote-unquote expected pay and can include a lot of grant date lumpiness, for example, for newly hired CEOs. Warren, want to take a stab at that one?
Sure. For our pay-for-performance analysis, we will be using grant date pay numbers. Our evaluation on the advisory vote for compensation will take realizable pay into consideration as part of the analysis for that. In terms of the bumpiness of the pay, by using a 3-year weighted average pay, we should smooth out any lumpiness associated with granting patterns or new hires. For newly hired CEO, there's also I see also another question that came in asking about how we deal with newly hired executives. For newly hired CEOs, that we basically, instead of looking at how much John Smith got paid during the year, we look at how much the company had to pay to keep the CEO post filled. And to do that calculation, so basically if there is outgoing CEO and a new hire, we look at how many months out of the year the outgoing CEO worked as CEO. We take a portion of that pay, and then we also add in the pay the incoming CEO received during the year. So that we basically, again, effectively calculating the company's, how much the company had to pay to keep the CEO post filled.
Okay, great. Nancy, do you want to weigh in on that question about realizable pay as well as the grant date question versus the realizable pay?
Yeah, sure. Actually, I didn't catch this. Warren, did you say that Glass Lewis will be looking at realizable pay in any way, or?
Yeah, so Glass Lewis will be using realizable pay information as a factor in evaluating the advisory vote on compensation. Exactly how we'll use that is not finalized yet, but we're in the process of looking at it. But realizable pay will not be a factor in the pay-for-performance analysis.
Got it. Yeah, so I just wanted to add a little bit of, I guess, my own observation on that. And I think most of you here are also aware that, ISS has come out with their guidelines, and they also mentioned that they are looking at realizable pay as well. And just like with Glass Lewis, is not part of their quantitative analysis. Rather, it's going to be considered in their qualitative analysis. And I think there is going to be some differences to how this realizable pay number is calculated. There are many different schools of thought on, exactly what goes into a quote-unquote realizable pay calculation. And what I can do is, I guess, talk intuitively about how I understood ISS, what the intuitive meaning of the ISS realizable pay is, and how it works in Equilar's realizable pay calculation. So from what I read, they will be doing Black-Scholes for options revalued using remaining term and updated assumptions. And that option valuation piece is perhaps the biggest difference between how they are looking at realizable pay and Equilar's definition. And the way that we consider those options would be the intrinsic value at the end of the valuation period. So that's just number of options times the appreciation in stock price. So that's the stock price at the end of the period subtracting out the strike price of the option. So intuitively, I think of ISS's method as a somewhat realistic estimate of a value that can be gained in the future by the CEO from awards that were granted to him or her in the past, however number of years. They haven't really said, what's the period that they would evaluate this. Whereas the Equilar realizable pay intuitively is if the CEO can liquidate and do liquidate all of the awards that he or she received in the last 3 years as of the fiscal year end, then what would that be? What would he or she get? So that's kind of how I interpret the two different models intuitively, and I just wanted to share that with you here.
Good. That was very informative, Nancy, about the differences between those two models. Let's move on to the next question for Warren. Warren, can you clarify which elements of incentive compensation are actual versus target, bonus, long-term cash, and long-term shares?
Sure. So the way we calculate total compensation is that we take the salary, the bonus, the non-equity incentive plan compensation numbers, and all other compensation numbers disclosed on the summary comp table. So the numbers, whatever numbers that they're displayed on the summary comp table or disclosed on the summary comp table, it goes into our calculation for those data items. And then we go to the grant table, look at the target number of shares disclosed for each of the batches, and we take the target numbers in along with grant date information, strike price information, and then we do our own valuation on equity grants. So the sum of these 4 or 5 different parts gives us the total compensation numbers.
Good. Thank you. Next one is for Nancy. Nancy, 2 questions about peer group methodology. The first one is what defines a path, and secondly, how do you define the distance of each path?
Okay, thanks, Nick. Okay, the path and the distance. So this is getting into the some of the terms that we kind of came up with when we're describing the peer group methodology. A path is basically a particular way that one company connects to another company. And I think the best way to illustrate this is, again, I'm going to go back to my Staples example. Staples and Office Depot. So Staples considers Office Depot a peer. So that path from Staples, so there is a path from Staples to Office Depot. Meanwhile, if I add Office Max into the picture, let's say Staples also consider Office Max a peer, and Office Max considers Office Depot a peer. That's right, yeah. So then a second path that exists between Staples and Office Depot is through Office Max. So in this example, Staples, the direct path between Staples and Office Depot, that would have a distance of 1. However, the Staples path to Office Depot through Office Max would be a path with a distance 2. And I know this is, somewhat confusing, and if it's still unclear, feel free to shoot me an email after. I'll be happy to send you a white paper that we put together on this and that has additional examples as well.
Excellent, thanks. We had a few questions come in as we were talking here, so we're going to now move to some of the live questions. One of the questions that came in was, as the Russell 3000 companies are used, would you ever consider using non-U.S. traded peers? And I'll throw that out for either Nancy or Warren.
Yeah, so I could take a first stab at that, and I actually saw there are 2 or 3 questions related to how this works for both non-U.S. companies and non-U.S. peers. So the algorithm as it stands today does not include any non-U.S. traded companies. The scope of this is only in the Russell 3000, and that is the network that we built. However, we are actively considering adding non-U.S. traded companies or non-U.S. traded peers to the network. So the reason for that, interestingly enough, is actually because of some work that we are doing for Canada. So we're currently building market peers in the context of the Toronto Stock Exchange, Canada. So one of the observations we made there is there are a lot of Canadian companies that benchmark to U.S. companies. And because the Canadian market is relatively small compared to the U.S., this percentage occurrence is high for Canadian. So we would really like to, because that's essentially, you know, what the market choice, we would like to take that into consideration, definitely. And there are a few things we're currently working out. One of these will be currency conversion handling. So a peer group doesn't do any good if we're not using it to benchmark something. So if we're using this peer group to benchmark pay and we're throwing in, you know, companies from different countries, we are currently working on some of the options in terms of converting all the pay numbers into one common currency. How do we handle stock grants that are made with, you know, equity trading on different markets, different foreign markets. So as soon as we kind of iron out some of those kinks and figure out how we're going to handle that, the market peers would definitely be expanded to non-U.S. traded companies.
Warren, care to add anything to that?
You know, what I'll say is that you know, we will work closely with Equilar in looking at the issue. You know, we believe the market peer algorithm methodology is really a sound methodology in looking at peers. So as we work together, we you know, determine that it may be appropriate for certain markets to go, including, you know, international companies, then we'll incorporate that into our model.
Thanks. So while we're on that kind of subject, Warren, I got another question for you that just came in recently. You mentioned that the performance, this has to do with kind of the weighting. The performance of for 1 year is weighted more than the 2 and the 3 year average performance. What is the weighting difference? Can you go into a little detail on that?
Yeah, so I also see a couple other questions about weighting. So there's also, it looks like there's a question about weightings between the performance data points, EPS, TSR. So all the performance data points are weighted equally. That means that you know, EPS count as much as TSR growth, as much as you know, return numbers. In terms of weightings between the years, that is a proprietary part of the model. So all I can say is that to give you a little bit of indication as to, you know, what's weighted more is that the most recent year, whether it be compensation or performance, are effectively weighted the heaviest.
Excellent. So I'll throw one out there for Nancy. Nancy, did you want to pull any out of the queue? If not, I've got another one teed up for you here.
Sure, go for it.
Okay, so kind of maybe a softball question, I don't know. When will the new Glass Lewis Pay-for-Performance Analytics be available within the Equilar application for subscribers? And there are quite a few subscribers on the line here, so let's be really specific. And then will there be any additional info provided to subscribers on how to maximize the new functionality?
Got it. Well, the tool has been in beta, excuse me, in the last month or so. We've been working closely with Glass Lewis and some of our clients on perfecting the algorithm and the user interface and all that. So I think it will be live starting from December 3rd. That's next Monday. Our launch is actually this Friday, so to our clients, you'll be able to access this. The Governance Center clients will be able to access this starting December 3rd. And if you are looking for additional information and also a demonstration, please contact your Equilar account manager, or if you don't know who that is, send us an email and we'll put you in touch with your account manager. But the functionalities in the tool is or will be available starting on Monday.
Well, thanks. Thanks, Nancy and Warren, for joining us today and enlightening us on all these issues today. Of course, if we didn't get to your question, we'll follow up in an email, as always. The slides and the replay will be available in the next couple of days. They'll also be available at Equilar.com. If you have questions specific to your company and your peer group, we're happy to answer them. As Nancy mentioned, contact Equilar. We'll set up a time that is convenient for you to show how it works. Well, it seems like it'll do it for our rebroadcast of the in-depth review of the Glass Lewis pay-for-performance model. On behalf of Equilar and Glass Lewis, my name is Nick Ezzo, and I'd like to thank you for visiting with us today, and may all your peers be aspirational.